Right, good day, grade 11s. Now we have to quickly look at leasing, which is the fifth method of acquiring a business, the fifth avenue of acquiring a business. And then leasing is a method whereby a business pays for the use of an asset, example, equipment, land, material, for a certain period of time instead of buying the asset that is leased. The second slide, leasing business assets. Leasing, another word for leasing is renting. You are going to rent the business assets. A lease is a contract by which land or movable property is rented for a specified time by the owner to a tenant. We are not going to buy that product, or you are not going to buy that equipment or asset and make it yours. You are just going to rent it for a specific period of time. Then it can include assets such as equipment, buildings, homes, flats, machinery, vehicles, etc. With homes and flats or buildings, we know that our sisters and brothers who are in the tertiary institutions, they do not have a place to stay, so they are hiring or renting specific rooms from the landlords so that they can spend a specific period of time there and pay a specific amount of money. After they are done with their studies, then they now give a notice to the landlord that we are going to finish with our studies during this year. Then that's the end of their contract with the landlord. That doesn't make that house theirs. Then startup capital is needed, whether starting a business from scratch, buying an existing business, or even buying a franchise. And the entrepreneur may not have sufficient capital to buy all the equipment or other assets needed by the business immediately. Then the lessor is the person or organization which agrees to lease the assets to another person or organization. Again, here we are going to have two parties. We have the lessor and the lessee. The lessor is the owner of that asset or equipment. The person or organization which agrees to lease or rent the assets to another person or organization. Then the lessee is the person or organization which pays to hire the assets. The lessee is the person who's going to hire or rent the asset. Then on issues to be considered. Leasing enables an entrepreneur to start a business without a large capital layout. You can pay deposit. If you do not have the whole money that you have to pay for renting, you can pay deposit. Then leasing can be defined as legal agreement that gives the business or the lessee the right to use an asset owned by someone else. They give you the right. As the lessee, they give you the right to use a specific roof, someone's house, for a specific period of time in return for regular payments. Yeah, they are going to give you the right to use an asset that is owned by someone else for a specific period of time in return for regular payments. Then it is possible to lease most of the movable assets a business needs, including vehicles, office furniture, store fixtures, computers, and manufacturing equipment. It is possible that you can lease all those things without buying them permanently for your business. Then there are two main types of movable asset leases. True leases. The lessee acquires no rights to the property other than its use. The lessee doesn't want to know anything else about the property. He or she just wants to use that property. Then the lessor remains the owner of the leased property, and the lessee's rental payments do not give him or her the ownership of the item. Even if you are paying a specific amount of money at the end of the month, that doesn't give you the ownership of the item. Then we have the financial leases. Allow the lessee to purchase the asset at the end of the lease term. At the end of the lease term, you may be allowed to purchase that asset. You are going to use it for a specific period of time, and then after using it at the end of the lease term, they allow you to purchase it. That is the financial lessee. Then we now the next slide. On the next slide, we have the advantages and disadvantages of leasing. The business gains use of the asset with no initial expenditure. That is the advantages of leasing. You gain use of the asset with no initial expenditure. You're not going to spend or contribute more money for using that asset. Then the business can acquire the latest technology without having to invest large amounts of capital. It's possible that you can tell them that, you know what, I'm looking for high quality or latest technology. I cannot hire this thing because this thing was established in 2010. I need the one that is established in 2019. Then the business does not carry the risk of expensive equipment becoming obsolete. If those equipment start being outdated, it is not your responsibility. You do not carry the risk of that. Then leased items are returned to the lessee at the end of the term of the lease. The leased items are going to be returned to the lessee, but to the lessor. Please be careful when you are going to return those list items to the lessor. Be careful that you must return them in a good condition. And then leasing improves, and then for the lessee, the lease payments are tax deductible. So the lease payments are tax deductible, which means you are going to pay less tax since you are also paying for the tax of lease payments. Then leasing improves the cash flow of the business. Leasing improves the cash flow because you are not going to pay a lot of money since you are not going to buy those goods permanently for your business. Then leasing is regarded as an expense to the lessee, and therefore it is not regarded as debt. We are going to pay for a specific period of time. Then after the specific period of time, we can carry on without paying that thing. So we cannot call it a debt, but we can call it an expense. Then disadvantages, the total of the lease payments may be more than the original purchase price of the leased items. The total of the lease payments, you can calculate, or how much did I pay for 6 months. Then at the end of the day, when you calculate that money, you find out that you could have bought your own equipment or your own asset. Then the lessee is bound by the lease contract. Even when the business may not need the items any longer, even if you do not need those items any longer, as long as you have entered into a contract and a specific period of time is stipulated in the contract. Then when the owner wants to sell the business, the lease will have to be taken over by the buyer of the business. When the owner wants to sell the business, the lease will have to be taken over by the buyer of the business. That is a disadvantage. You do not want the lease, you want to buy the business. So they are going to sell the business with the lease. Then to the next slide, we have contractual obligations and legalities on the next slide. All leasing agreements are concluded using strict legal proceedings and formal contracts are signed between the lessor and the lessee. When drawing up a lease contract, the following aspects need to be established: the lease period, the time period for which you intend using the premises or items, and whether there is an option to renew. Then after that, the cost over the period of the lease. This includes the basic rental, the operating costs, and maintenance and security services. The lease period, how long are you going to use that product for? Then is there any need or an option to renew that contract? Then the cost of the period of the lease, how much are you going to pay? This includes the basic rental, the operating costs, and maintenance and security services. Then we have the annual escalation clause. This means that the rent will increase by a certain percentage each year. You are going to pay a certain percentage of money each year. The lease is going to increase. The money that you are paying for rent is going to increase by a certain percentage each year. Then we have slide number 6 and 7, 7 and 8. We are going to do end of topic questions. This is going to be based on this presentation, then the first two presentations that we have done. Then please be careful. answer those questions. Please make sure that you do those activities in your exercise book, in the first exercise book in the front, after the previous activity we have done. Then this is the last term 1 lesson that we have done. Then please do the activity. Then I will send you the answers to mark. Thank you very much and good luck.